Hello, everybody. Today we will be looking at Chapter 3 of the Fundamentals of Financial Accounting course. You should now be familiar with journal entries as well as the debit and credit system. Today we will be going one step further and looking at adjusting journal entries. Now, before I start here, what you should do is you should visit SFU Canvas and download the blank Word file and possibly print it out so you can fill it in as we go. So the first thing we're going to talk about is the time period assumption. We're going to assume that accounting information is recorded at regular intervals. And this kind of ties in directly to adjusting journal entries because typically at the end of the month, or end of a quarter, or even end of the year is when adjusting journal entries are made. The accounting period is any given period that is reported on the financial statements. So the most common periods we're familiar with are annually. That's the most common one, and also quarterly. So there can be instances where we need to produce information in a shorter time frame. So sometimes your monthly financial statements also. A fiscal year is a company's year-long reporting period. And as you might expect, the most common one is from January 1st to December 31st. But in actuality, you can pick any fiscal year end date that you want. For example, you could go from August 1st to July 31st, for instance. Looking at revenue recognition criteria, the two rules about revenue recognition. First, we look at when it's best to record revenue. So we should only make a journal entry to record revenue, be it sales revenue or service revenue, after we have completed a good or service. And to add to that, we should be reasonably assured that we can collect from our customer or client. So if you do some work and you kind of know that you've done it on a goodwill basis and they won't be paying you, you should not record that revenue. And second, the amount of revenue to record. So this is a pretty straightforward concept in the sense that whatever you bill your client for is the amount of revenue you should record. So accountants need to be careful with that because sometimes managers may prefer to understate revenues to avoid taxes. Most people don't like paying taxes to the CRA, or they might overstate revenues if their bonuses depend on it, or if the stock price depends on that, right? Higher profit generally mean higher stock prices. So the next concept is commonly known as the matching principle. So we only recognize expenses if they meet these three steps. So we want to first identify all the expenses incurred during the accounting period. We want to measure the expenses, and we want to match expenses against revenues. So in essence, we only expense something after we realize the benefit from it. Looking briefly at the net income formula, this is kind of a visual graphic representation of what's going on. We take our revenues, which are hopefully more than our expenses, and we take off the expenses. In this case, it's 1,000 for revenue, 700 for expenses, and we're left with net income, which is $300 in this case. So the main point behind this illustration is to emphasize the importance of linking expenses to revenues in a given period. Only expenses which can be linked to revenue generated in a period should be included in our net income calculation. We're going to go into an example here. Let's assume the SFU bookstore manufactures fridge magnets for retail. So we're going to make 1,000 magnets this quarter at a cost of $2 each. And we're going to ask the question, should the cost of production for these 1,000 magnets be immediately expensed in the current period? And the answer is no, according to the matching principle. We can only do this if all magnets produced were also sold during the same period. So according to the expense recognition criteria, the expense of each magnet must be linked with the revenue of each magnet. So if all 1,000 magnets are sold next quarter, in quarter 2 for $3 a piece, we would expense the $2,000 cost of production in quarter 2. The magnets will be shown as inventory at quarter 1 then, balance sheet, since they're assets which are expected to benefit the bookstore in the future. So if you recall, an asset is anything that's expected to help you earn a profit or make money in the future. And in this case, even though we haven't sold the magnets yet, we have them after we made them, and they will presumably help us make money in the next quarter or even at a later date after that. So let's try a question here. Assuming we correctly recognize revenue and expenses for both quarters with all the magnet sales in quarter 2, but recall that the magnets were actually produced in quarter 1, what would be the revenue, expenses, and income added from the magnets in quarter 1? And down below, over here, we have what about quarter 2? So what we'll do here is, I'll give you a minute to go ahead and try this, and we will cover the solution in the following video.